In just 80 minutes, over $1 trillion of value was wiped off the precious metals markets. Gold crushed, silver decimated, screens around the world flashed red, portfolio balances evaporated, decades of safe haven narratives were tested in a single brutal session. But here's what almost nobody's talking about. While that smash was unfolding in real time, something happened quietly in the background that has never happened before in the history of silver as an asset class. At the same time, one of the most important precious metals hubs on Earth, the Shanghai Gold Exchange, suddenly went dark on silver. No numbers, no inventory data, no explanation. When big institutions start hiding data and corporations start quietly changing how they treat silver on their balance sheets, that is not noise. That is a structural shift. Welcome to this special alert. If you've spent years working, saving, and trying to protect your family's wealth, this episode is for you. Stay with me until the end because we're going to unpack why this smash happened, who may be engineering the moves beneath the surface, why Shanghai went silent, and the single most important development in modern silver history, a publicly traded company formally adding physical silver to its corporate treasury for the first time. This is not panic. This is not clickbait. This is a paradigm shift that serious investors cannot ignore. Segment 2, Setup, Credibility, and CTA 234. Before we dive deep, let me say this clearly. This video is educational, not financial advice. I'm sharing research, patterns, and my own interpretation of what's happening. You must always do your own due diligence. If you appreciate straight talk, no fluff, and no sugarcoating about silver, gold, and the real mechanics of this system, hit that subscribe button the same way you'd do a favor for a trusted friend. It costs you nothing, but staying ahead of these moves could be worth a lot to your future self. And in the comments, tell me, where in the world are you watching from today? We have silver investors, gold stackers, and serious thinkers tuning in from every corner of the globe. All right, let's rewind to that morning in February 2026 and see what actually happened. Segment 3, the $1 trillion smash. What happened in 80 minutes, 4 to 8 hours. The morning of February 2026 did not begin quietly. Within just 80 minutes of the market opening, roughly $1 trillion in value was erased from the precious metals space. Gold dropped around 2%. Silver collapsed roughly 5.4% in that window alone. Not in a day, not in a week, in barely more than the time it takes you to drink your morning coffee. According to one breakdown, gold's move translated into roughly $740 billion of value erased. Silver's decline removed about $2.6 billion. Now here's the key question. Was this just normal volatility, or did something more engineered happen under the surface? Let's start with the official story. The first major trigger was the US dollar index, the DXY. On that morning, the dollar shot up sharply, almost 1% in a matter of minutes. In modern markets, this relationship is old and simple. When the dollar spikes hard, precious metals, especially gold and silver, typically sell off. Large funds de-risk, move into cash, and hit the sell button on anything that's perceived as risk or hedge. It becomes a sell everything moment. And that's exactly what happened. The dollar surged, and silver paid the price. But that's not the whole picture. In the background, geopolitical tensions, especially around Iran and the wider Middle East, were escalating. Markets hate uncertainty. When you combine a spiking dollar with rising war risk, you don't just get volatility, you get a perfect setup for a smash. However, even after acknowledging the dollar spike and the geopolitical fear, something about this move still didn't look natural. The speed, the precision, the timing. So the real question isn't just why did silver drop? The real question is who benefited from this exact kind of drop at this exact time? To answer that, we need to look at volatility, at volume, and at the players behind the scenes. Segment 4. Volatility isn't a bug. It's the feature. 8 hours 11:30. Now, if you've been in silver for more than 5 minutes, you know this metal is wild. But the last stretch took that to another level. Since January 26, 2025, silver saw 5 separate trading days where the intraday range, high to low, was between $10 and $15. 3 days where that range stretched between $15 and $20. 1 day with a range of $20.25, and one truly extraordinary day where silver moved about $44 from top to bottom in a single session. Let that sink in. A $44 intraday move on a metal that not too long ago was trading around $31 per ounce. In fact, roughly 40% of the last 25 trading sessions saw a $10 or more intraday move in silver. A year before that, silver sat around $31. This is not normal by textbook standards, but here's the twist. Volatility in silver is not a sign that silver is weak. Historically, silver has always been violently volatile. So the question changes from why so volatile to what is volatility being used for? Because when moves become this fast, this hard, and this precise, Serious analysts do not just shrug and say, oh well, markets are crazy. They lean in. They start asking, who's on the other side of these trades? Who has the size and the structure to benefit from washes like this? That's where this story gets uncomfortable. Segment 5, the surgical dump and a mysterious giant, 11:30-15:30. Let's zoom in on the actual price action. The day before the smash, silver was trading near $98 per ounce. By the time the New York market really got going, it had been pushed down to around $79. That's roughly a $19 overnight collapse. No major mine suddenly reopened. No giant new deposit was discovered. No industrial demand category disappeared overnight. Fundamentals didn't justify a freight train hit like that. Yet, that's exactly what the chart showed. A controlled demolition from high 90s into the high 70s. So analysts started digging. And one name kept coming up in serious conversations: Jane Street. Now, if you're not deeply into market microstructure, you might never have heard of them. Jane Street doesn't market to retail. They don't do influencer campaigns. They operate quietly, professionally, at enormous scale. Here's what the data showed. In just the fourth quarter alone, Jane Street added about 20.66 million shares of SLV, the largest silver ETF in the world. That move made them the largest holder of SLV on the planet. Independent outlet Zero Hedge flagged this immediately, warning that there was serious financial engineering taking place inside the silver market, with Jane Street sitting in the middle of it. Why did that make some analysts nervous? Because this was not the first time Jane Street had been associated with controversial market behavior. During the Terraform Labs, Luna UST collapse in 2022, Jane Street's name surfaced in accusations of possible insider trading, manipulative activity connected to that meltdown. There were also serious allegations, backed by timestamp data, that Jane Street was systematically selling Bitcoin at exactly 10:08 a.m., day after day, during a major decline, in a way that was very hard to call a coincidence. And now, the same firm sits on the largest SLV position ever recorded. On the same day, silver collapses nearly $19. Let's be careful here. We are talking about speculation, not court-proven fact. But speculation based on observable patterns and flows is not conspiracy theory. It's called pattern recognition. Smart money pays attention to patterns like this. Retail usually doesn't. That difference is often where the transfer of wealth happens. But the story doesn't end with one firm or one ETF. There was another, even louder signal coming out of the futures market. Segment 6, futures flip, backwardation, and physical stress, 15:30-18:30. Zhugan and many other analysts pulled up the COMEX silver futures curve. What they saw was one simple, powerful word: backwardation. In a healthy commodity market, futures are usually priced above spot. Why? You pay for storage, you pay for time value, you pay a small premium to lock in future delivery. But on that morning, something was wrong. The spot price of silver was actually higher than the price of the May futures contract. The curve had flipped. That means buyers did not trust future silver supply enough to pay a premium. They wanted metal now, not promises later. Confidence in future delivery had collapsed. At the same time, registered silver inventories at COMEX had been trending steadily lower for months. So now the futures market was screaming in plain language what the inventory data had been quietly whispering. Physical silver is getting dangerously tight. And just as that reality was surfacing in the Western futures market, on the other side of the world, something even stranger happened. Segment 7, Shanghai goes dark. When a giant turns off the lights, 18:30-21:30. For years, the Shanghai Gold Exchange has been one of the most important sources of silver inventory data on the planet. Every single week, like clockwork, they publish detailed figures, silver stock levels, movement data flows in and out. Then, in the week of February 24-27, 2026, something unprecedented happened. Shanghai went completely silent on silver. The report came out. The gold section was normal, but the silver section, no inventory numbers, no stock data, no movement data. Every single line related to silver was just empty. Independent analysts across the globe cross-checked the files. This was not a translation issue, not a formatting error, not a missing page. It was a deliberate withholding of silver data during one of the most turbulent weeks in precious metals history. To understand why that matters, you need to understand what Shanghai represents. China is not a side character in the silver market. It is the dominant force, the largest refiner, a massive industrial consumer for solar panels, electronics, and EV components, a key hub for physical settlement and delivery. When a market like that stops reporting silver data in the middle of a global smash, it is sending a message. Historically, when major exchanges go silent on inventory during stress, three things tend to be true. Supply stress is being hidden. Numbers would look so bad that publishing them would trigger panic buying. The exchange is buying time. Decision makers need space to manage a tight situation before the public sees the full picture. Something big is about to move. Data blackouts like this often precede major structural shifts, not just small corrections. Now add to that Asian equity markets were also cracking. Japan's Nikkei dropped nearly 5% in a single session. South Korea's Kospi 50 collapsed nearly 9% in one day. All while, silver was being smashed. COMEX was flashing backwardation. Shanghai was switching off the silver lights. This is not random noise. This is systemic stress. Segment 8. Geopolitics, liquidity, and the printing press. 2130-2330. Layer on top of all this, the geopolitical backdrop. Tensions around Iran and the wider Middle East weren't just a regional story. They threatened the Strait of Hormuz, through which roughly 20% of the world's traded oil flows. Any serious disruption there doesn't just move oil, it moves everything. Shipping costs, supply chains, industrial production, inflation expectations. And every time this kind of systemic shock builds, governments, especially central banks like the Federal Reserve, end up doing one thing. They print, they inject liquidity, they expand balance sheets. History is crystal clear. Every major geopolitical crisis in recent decades eventually ends at the printing press, and every time the press runs long enough, gold and silver respond. Not always instantly, not always in a straight line, but over time with historic force. Even respected analysts like Jesse Colombo noted that despite the smash, the broader precious metals bull market remained structurally intact. The 200-day moving average on gold was still sloping upward, unbroken. Gold futures were still trading near key breakout levels, even after the wipeout. In other words, the price was screaming panic. The structure was whispering, bull market not dead, just tested. But while everyone argued about manipulation, dollar spikes, and Shanghai data, something else happened, quietly, in Scottsdale, Arizona. That could prove even more important than the smash itself. Segment 9, the Scottsdale bombshell, silver enters corporate treasury, 2330-2730. In the middle of all this chaos, red candles, dark data, collapsing Asian indices, a quiet announcement slipped out of Scottsdale. Most people missed it. Financial media basically ignored it. But anyone who truly understands silver should have stopped dead when they read it. Jugan F., CEO and founder of Scottsdale Mint, revealed something that has never happened before. A publicly traded company had approached Scottsdale Mint to complete the paperwork needed to add physical silver directly to its corporate treasury. Not Bitcoin, like MicroStrategy. Not just gold, not T-bills or cash equivalents, but physical silver as a formal treasury asset on a listed company's balance sheet. Central banks were already buying, private banks were already buying, institutions were already accumulating. But this was the first time a public company was officially treating silver as a strategic treasury asset. To grasp how big that is, think about what corporate treasury management really means. For decades, treasuries meant cash, fiat and bank accounts, maybe some short-term bonds. Michael Saylor shattered that with Bitcoin. Tesla amended its bylaws to allow Bitcoin and gold bullion. But silver was never invited to that table, until now. Imagine thousands of listed companies worldwide, each sitting on millions, hundreds of millions, or even billions in cash reserves. Now imagine even a small fraction of those treasuries reallocating just a few percent into physical silver. That isn't retail stacker demand. That isn't trader demand. That is balance sheet SEC filing level demand that does not panic sell in an 80-minute smash. It sits there, quiet, strategic, long-term. Combine that with a silver market running multiple consecutive years of structural deficits, industrial and investment demand exceeding mine supply, exploding consumption from solar, EVs, and advanced electronics, the rapid growth of tokenized silver, blockchain-based claims on fully allocated metal, following the same explosive trend we already saw in tokenized gold. Now ask yourself, what happens when central banks accumulate, private banks position, institutional products tokenize, and public companies start parking physical silver in their treasuries? All at the same time? That is not noise. That is the birth of a new asset class behavior. Segment 10. The real question. What does a serious person do now? 2730-30 Tilgers. Let's bring this home. We live in a world drowning in around $300 trillion of global debt. Geopolitical risk is at levels most of us have never seen in our lifetimes. Central banks have one reliable tool left: debase the currency over time. So if you're a serious long-term thinker, you have to ask, where do you place your confidence? In a bank account guaranteed to lose purchasing power every year? In an equity market floating on borrowed time and cheap liquidity? Or in real finite assets that governments cannot print at will? This is not about hype. It's about inevitability. The smash of February 2026 will be remembered, but not just as the day silver crashed. It may be remembered as the last time silver was this cheap, before the full force of structural demand truly arrived. Because while the retail crowd panicked, while headlines screamed, collapse, the quiet hands were accumulating. Futures curves were flashing stress. Exchanges were going dark. Corporations were signing paperwork. Silver, beaten, mocked, and smashed in 80 brutal minutes, might just be preparing for the most important phase of its modern history: Final CTA 30 rower end. If this breakdown helped you see beyond the red candles and into the structure of what's really happening, do 3 things for me. Like this video so more serious investors actually see it. Subscribe and turn on notifications. We're going to keep tracking Shanghai data, COMEX stress, and corporate treasury moves in real time. In the comments, type one word that best describes where you are mentally right now. Alert, if you're awake and watching closely. Positioning, if you're actively building a long-term strategy. On this channel, we don't just react to price. We study the system, we learn the patterns, and we try to stay 3 moves ahead. Stay informed, stay strategic, and as always, stay ahead of the game.